Hello, everyone. Jeff Fratarcangeli here, Fratarcangeli Wealth Management, for a call to action live market update. Here we sit on the heels of the election. We didn't know that we would have a decision to a large degree by this morning, but here we are with a pretty good understanding of where we're sitting, although I'm looking for my guest to talk a little bit more about that. Little background on Fratarcangeli Wealth Management. We're going on our 30th year. It'll be 30 years next year that I've been sitting at the helm of Fratarcangeli Wealth Management, building a practice of guiding and counseling and protecting clients through and navigating through the ever-changing environments in the economy and the laws and everything involving what we refer to as a multifamily office. What that basically means is that we look at every aspect of the financial picture for our clients, which are accumulated of business owners, businesses, executives, and family offices of the like, as well as athletes and entertainers, which Ron and I were just talking about offline. I've had the benefit of getting referred to some A-list celebrities as well as A-list athletes over the history of my career, which, having been a college athlete, something that I miss and enjoy the energy of, and helping folks navigate that shorter career. And it's just been something that's come about. But my focus is predominantly in the entrepreneur, CEO, public, private, and executive groups and everything that comes with it. And as a multifamily office, we work with the estate planners, we work with the tax professionals, we work with the group benefits and property and casualty, and everything that involves the financial picture of protection to help guide our clients and making sure they understand where the blind spots are. And today we have the stock market as our primary focus, as daily is our main focus, which is where to invest, how to invest, and how to make sure that we're taking advantage of opportunities, not being emotional, looking at where the puck is going versus where it is currently, getting an idea of what changes have occurred. And we have some changes. It looks as though we're going to have a Republican total control, possibly. I'm not certain if that's completely accurate, but certainly the president and the Congress, which is the House and the Senate, appear to be positive in the sense that it's going to be red. And that means some change. So we need to understand how to play that. But taking a step back, let's just talk about the data before I introduce our esteemed guest, which I know many of you have seen before, not just on our market updates, but on CNBC and many other outlets alike. And I'll introduce who he is momentarily. But, we sit here today with, looking at earnings upon us. We're 70% through third quarter earnings, and we've seen a very nice earnings report, and that 75% of companies have beat on the earnings per share, and 60% of the S&P 500 companies have beat on revenue. These are very positive numbers. We're looking at a 5.1% earnings growth quarter over quarter from last year, third quarter, and that'll be the fifth straight quarter of earnings increase, which is strong. And then even more compelling is the fact that we're looking at between today and the end of 2025 through the fourth quarter at 11+% earnings growth throughout that time frame, which I have to tell you, over a 30-year period, not to mention the folks that were training me early on that have been there longer, you don't see those types of double digits earning growth timeframes like that appear to be upon us. And so that's very strong. So we have a number of things happening that are compelling fundamentally, but we want to talk about if anything on the horizon is concerning. Like, for example, the Fed is speaking tomorrow. Are we going to get a rate cut? Does anything change with the regime change that we're going to ultimately have in what the Fed does? Is there any data that's changed? We see the dollar stronger today. We see interest rates are holding strong here at a 10-year at 4.3. We see a number of factors, including cryptocurrency jumping very high. There's a number of reactions taking place. I don't need to tell many of you that the market today is up roughly 3% on the Dow and between 3% and call it 2% on the three major domestic indices. That's a major move. And that's not too uncommon. The uncertainty might have subsided to some degree, but you have to take a step back and you can't chase. You have to realize that let things settle in. Let's see how things play out. And that's why I lean on some of the folks that I respect and have utilized the most in our network. We're here at Wells Fargo custodian our assets, but we have a platform and we have a network that I would put against any network of professionals that we can reach out to at an instant's notice and get their opinion or help them help our clients. And the esteemed guest I have today, Ron Insana, I don't think needs any introduction. I always refer to him as someone who has experience on Wall Street, Main Street, and in Washington, having worked in all three categories to some degree. And many of you recognize him because he's been on CNBC for even before I was in the industry. We may remember him back on 9/11 being one of the key reporters. Not to mention he started CNBC, so his knowledge is extensive. He looks at things differently than I typically do, which is what I want. And I'm just honored to have you here, Ron, and appreciate you coming with us today on pre-planned post-election. Not knowing, obviously, neither of us, I don't think anybody knowing where this was going. Everyone had an opinion, but no one knew. You know, I don't really have a specific question other than what I've mentioned. Where are we? What do we need to get prepared for? What sectors do you think may ultimately benefit from the change? I think the one big question is, does the Fed do anything different now that we have a regime change? But I think
It's
there's
great to
just
be
so
here.
many.
Yeah, thanks for that very generous introduction, Jeff. Look, I think, you know, today is an obvious reaction to what I think Wall Street perceives to be as a very business-friendly, economy-friendly set of developments. As you said, we don't know yet, but if the House is retained by the Republicans, that's a clean sweep, and you could expect lower taxes for corporations, possibly lower taxes for individuals, deregulation across a wide variety of industry verticals. And those are the positives that I think that the market is responding to. As you say, if we step back, there are some other things that might, in the longer run, be more concerning for market and economic behavior, which would be some of the things that the president's talked about: tariffs across the board, 10 to 20% tariffs on all goods that come into the United States, 60% on Chinese goods, and he even threatened, triple-digit tariffs on products coming in from Mexico. So there's that. There's the discussion, and one of President-elect Trump's spokespeople this morning came out and suggested that mass deportations of undocumented immigrants would start on day one, which would affect, obviously, the labor force, depending on whether you're talking about 11 or 20 million different individuals. The labor force is about 160 million people, so that's a rather substantial chunk of the labor force. Both those things are, by definition, inflationary, which is why I think you're seeing bond yields move. The 10-year note now approaching 4.5%. Inflation break-evens, when you look at those, have gone up rather substantially. In fact, both have gone up almost a full percentage point since the Fed first cut rates. So the bond market is pricing in more inflation. And then there's some talk that if Elon Musk and John Paulson get together and they end up in the Trump administration, talking about cutting $2 trillion from the federal budget in rapid fashion, which would obviously disrupt economic activity to some extent. So right now, I think, the short term is obviously a positive reaction. I think we're going to have to wait to let the dust settle to see whether or not, in combination, all these things work to grow the economy uniformly. I think the other thing that's also being discounted in the market too, and you see this in specific sectors like banks, you see it in technology, merger and acquisition activity, there's going to be much less regulatory scrutiny, it would seem, of that type of activity. And so, private equity firms that trade publicly are getting a big bump today as well. So, you kind of go sector by sector. Those companies like, green energy companies, if indeed the president were to get rid of electric vehicle subsidies. Interestingly, Tesla's up 13% today, and EV subsidies could go away. That's largely how Tesla makes its money. So there are some cross currents in here that are kind of hard to explain. But the simple fact is, as you stated, I mean, the market is responding positively to what appears to be a near sweep by the Republicans.
The Fed tomorrow is going to speak. We've seen the Fed unprecedentedly lower interest rates in November, unheard of, never done before. Does that change their posture tomorrow? Will we see a rate decline? Why would there be a change, if any? Your opinion?
Well, we got that very soft employment report, some of which, obviously was affected by the terrible hurricanes and also by the various strikes that we had. Boeing employees just agreed to settle yesterday. So those numbers were artificially depressed, it would seem. But still, the trend in employment growth has slowed considerably. That's where the Fed focus has been of late. So I'm expecting them to cut a quarter point tomorrow and maybe again in December. And I think they'll then hold their firepower to see what happens when the Trump administration comes in, in early January, as to how quickly it moves to enact some of the policies that we just discussed.
I'm going to shift for a second. I'm going to come back to economic activity and targets for the market. And I'm going to talk about geopolitical and the fact that we have so many things happening across the globe today. Israel, Iran, obviously Russia and Ukraine. I know Russia came out today and said he wants to do a reset. Putin said he wants to do a reset with the United States, which I find interesting. And then, of course, we have Taiwan and China. Your opinion on what could be the reactions as well as the implications of the market and anything of the like. If you have, I mean, you've been in Washington. Listen, you have been through things and seen things, and you're connected to the groups that I don't have as strong connection to. What is your interpretation?
Well, I mean, I think, again, we have to kind of go back and I assume take President-elect Trump at his word that he wants to solve the Russia-Ukraine war very rapidly, which most likely would mean conceding Ukrainian territory to Vladimir Putin. That would not be favored by our European allies or some others, and some might, particularly the Chinese government, might view that as a concession that would open the door to the Chinese going after Taiwan. So there are a lot of moving parts here, and I think the military establishment is concerned when you look at some of the commentary that we've seen from the likes of General McChrystal or a whole host of others who have spoken out. I think they have some concerns about U.S. international alliances like NATO, whether or not we pull out or attempt to pull out, although Congress kind of codified our presence there, but we'll see whether or not that norm is broken. I think it opens the door to a wide variety of outcomes, none of which at this point in time are easily predicted. I mean, what happens with North Korea? They're, now sending soldiers to fight in Ukraine. The Iranians, of course, have attacked Israel and may do so again. There are a lot of moving parts here, and it's very difficult, I think, to assess, not knowing yet who's going to be in the Trump cabinet when it comes to national security positions, when it comes to Department of Defense. Very difficult to say, other than the broad sweep that President Trump has suggested. He would like to solve all these problems, particularly Israel and Hamas, or Israel, Hamas, Hezbollah, and Iran quickly. I'm not sure what that means, and I don't think anybody really has a good handle on it quite yet. And so in this interim period here, who knows what the Biden administration may do? They may give Ukraine more weapons and also give them the green light to use long distance, material to strike deep inside of Russia as a parting gift to Vladimir Zelensky. Don't know. So I think there's a period of uncertainty around geopolitics in this 2-month period where you have a lame duck president who may not act as lame as others have, just given that he's got a very limited window in which to make good on some promises that have yet to be fulfilled.
Valid points. The fact that, typically after an election through January, it's handoff of the torch. Typically nothing's done, but this may be different.
Yeah.
We may have some activity. I think that the adversaries and the folks that are at odds with or allies or not are realizing that this is going to be a different negotiation, and how that plays out is anybody's guess. It'll be interesting to see how that plays. But I think the fact that we've heard multiple times, whether it's true or not, I think that there is some factual aspects to it, in that the revenues generated to allow many of these nations at war to have the revenue stream to go to war, because of the fact that they're the main source of energy and resource. We don't need to say who, who. Russia, as an example, many others that have had the opportunity in the Middle East to generate the revenues that they have the last 3 years that they probably won't have if drill baby drill comes to realization. So there's a number of offsets there that you would expect that would play into this, and and they realize that they're going to be facing a different conversation completely. And I think no conflict is great, and I think ultimately going back to the markets, drill baby drill and logistics and energy prices coming down. These are certainly factors that I would expect to take place. Setting aside political affiliation, talk about GDP impact. Talked about us becoming energy independent versus dependent. How does that play? How do we play those call it sectors, if at all?
Well, it's interesting. I mean, so energy independence, I think, has already arrived. When you look at U.S. production, we're at 13.4 million barrels a day and rising, which is the largest amount of daily oil production in the history of the world by any individual country. So we surpassed that of Russia, Saudi Arabia, and others, and have now for quite a number of months. And with respect to natural gas production, the U.S. has been the largest producer of natural gas since 2017. So that's been in place, I should say, for quite a long time. But yeah, I mean, if for instance, President-elect Trump were to open up federal lands and offshore oil opportunities, clearly prices would go down, and they are down today. We've seen oil break $70 a barrel already. GDP is going to be a tough one. I think that, again, this is, and this goes back to the original, Trump administration, the first in 45. Do we take him literally, but not seriously, seriously, but not literally, or do we take him literally and seriously that he is going to, number one, impose the tariffs that we talked about earlier? Number two, is he really going to deport that many people? Will there be, as Stephen Miller has suggested, internment camps set up in Texas, to move people out of the country en masse, which would have a huge impact on the labor markets. And we have a domestic employment shortage, so that would stoke wage inflation. So you can trace out, and again, this is policy analysis, not personal preference. You can trace out an economic environment in which stagflation might become more likely if you have tariffs, if you have mass deportations of workers, and then you also have an easier Fed and maybe even stimulative fiscal policy. You could see inflation accelerate and growth decline at the same time. I apologize for the continued wiping below the nose, but did a little shaving damage earlier in the morning.
This election's been dangerous.
It's been very dangerous.
Okay.
Yeah, it wasn't my wrist. I was just going straight for the nose there.
You missed.
I missed, yeah. But I think I think it's really tough to make the call right now. And again, I think if for instance the House were to flip and go Democratic, there might be some breaks on some of the policies that the president's proposing. If not, look, House Speaker Johnson even suggested dismantling the CHIPS and Science Act, which would diminish U.S. incentives for building out manufacturing capacity in the United States. So
how well did that work in Intel in Ohio?
Right. Well, Intel in Ohio, Taiwan Semi in Arizona, which, by the way, is putting out its first fab that has just been sold, and it's been successful thus far. Until recently, manufacturing jobs have been expanding. So I think, again, it really comes down to what kind of latitude does the president-elect have? Will he actually go forward with all the things he said he's going to do? My guess is he's certainly going to try. But the economic consequences may be unintended. I'm not sure that would be necessarily as positive as some people assume at the moment.
Well, interestingly enough, your concern with stagflation, I'm going to push back a little bit, Ron. We're having a conversation. Sure. Historically, in his first 4 years, the GDP and productivity exploded prior to COVID. And the policies aren't that different. I think his resistance might be slightly different if he has full control. Not to mention he had 200 cabinet members ultimately over 3.5 years that finally got approved in the third or second year. I think he'll have more flexibility in that if he does have the control. Not to mention, I hope he learned something the first go around. So maybe his execution will be greater, but the productivity was not a negative factor until COVID. It was very strong. So why
now is our productivity is exploding in the U.S. And in fact, we're outpacing other countries by a factor of 2 when it comes to the productivity surge that we're seeing in the U.S. with the advent of artificial intelligence, with the manufacturing capacity being built out. We're actually doing quite well by that measure. Hopefully that will continue and nothing gets in the way of that, because productivity means non-inflationary growth and expansion of GDP. So if we can maintain that, it would be a really good thing. And I think that's a question that's going to be critical from an economic perspective. We've had stock market booms with or without productivity booms. So I think it might be less germane to the equity markets, but more germane to GDP growth.
I'm going to push a little bit here, Ron, and I know you'll give it to me straight. The data that we've seen recently, and when I say recently, leading up to the election, we've seen one number, and then a year later or months later, we get an adjustment that's far less opportunistic. The unemployment number is the obvious. And then when you read the tea leaves and you look at the data when they come out with unemployment and they give a narrative that's very positive, you find out that the number of jobs created was predominantly government jobs. But yet the narrative is so
You're talking about last month.
I am, but I'm talking about multiple examples. I'm using last month in I actually read it and I looked at what the job creation was, and I also heard the narrative, and they were far different from what I read versus what was stated. Now, my concern is, and listen, my job is very clear. I'm not going to be political. I am going to do what's right for my clients, and I'm going to make sure that we're seeing things as clearly as we should. And having been here for 3 decades and heard things multiple times, I can hear 2 notes and tell you the song. My concern is that the data that we've been getting leading up to the election, that's been very it's been very optimistic, and then adjusted when no one cared anymore. What are we going to be seeing in the coming quarters with the data, and then finally the narrative around it? As I sit back, my biggest fear, I think there's always going to be turmoil, but that's the thing that I think could affect confidence. And do you have an opinion?
Yeah, look, I mean, I've been doing this 40 years. So, the Bureau of Labor Statistics is populated by lifelong bureaucrats who belong to both parties and who have been crunching numbers independently of the White House since the Nixon administration. President Nixon did try to interfere with employment numbers at one juncture during his time in office. And so they separated rather decidedly and decisively BLS from any White House influence. So, at this point, any president gets those numbers on the Thursday before the unemployment report is released. So the White House doesn't know till the day before. With respect to the benchmark revisions that you're alluding to, which occur on an annual basis, we've seen this time and time again, upward and downward each year, that the Bureau of Labor Statistics, as they collect more and more data, they revise the numbers. So we had an $818,000 individual downward revision in the overall growth of jobs, but it was still over 2 million in the course of a year. So it was still strong growth. And one of the other problems that we're having of late, particularly with the payroll survey that the employment report rests on, where we talk about how many jobs are created every month, is the response rate from corporations has been falling consistently over the last several years. And so there's a lot of catch up that has to take place in order to get cleaner numbers. And then they reconcile those with weekly jobless claims data to arrive at that revised figure. And so I'm a little less concerned about the data or the narrative for that matter. I haven't seen any evidence that employment was far weaker in the economy over the last couple of years than we thought. Listen, if you travel,
yeah, but Ron, they adjusted the number 1%. Well after they gave the number the first time.
But they do this all the time, Jeff. They do this every year.
1%? 1%.
No, I mean, again, the response rate has fallen from corporations rather dramatically. It's something like 40% of corporations respond to the survey in the week in which it's delivered. So it takes time to just rectify those numbers and get a much more accurate reading on an employment base that's 170 million people strong. So I don't see any major issue. I mean, we did see a surge of job creation. We have seen a productivity surge. The unemployment rate is hovering near 44%. It's been there now for the longest stretch since the mid-1960s. I don't think you can engage in a multi-year conspiracy that would inflate the numbers in such a manner that someone wouldn't say something. I mean, you and I both know that if you work in a corporation, keeping a secret, even in a small company, is almost impossible. Doing it in a large bureaucracy would be, I think, beyond any ability to do that.
So Ron, yeah. Ron, who's going to talk about the conspiracy? Which news channel should I watch?
I think any reporter worth his or her salt who got wind of that, and we've all done work on this. I mean, every economics reporter that I've ever worked with, whether it's directly at CNBC or the people that I know at the Wall Street Journal, Washington Post, New York Times, Financial Times, wherever you want to look, we've all examined these things again and again and again. And certainly haven't found any evidence of that.
Well, you're there. You're on the front lines. That's why you're here today. Okay, so understanding that to be the case, you had talked about, so kind of let's just summarize. There's a concern with the deportation, and will he really attack that to any major extreme? The hope would be that you identify the criminals or the folks that have criminal history, and you get them away from our citizens, and hopefully that's a small percentage. And then what do you do with the remaining group? And I think, logically speaking, we need workers, and having them stick around and getting them truly through the process of becoming citizens in a fashion that is appropriate. And then certainly make sure that we have a process that's in place at the border that restrains the future of illegal immigration, I think, is the hope that we all have. We'll see. I do say that hopefully Trump has learned from his first experience and handles this in a fashion that he surrounds himself with people he trusts that handles that appropriately. But the stagflation comment about not having workforce to support the need and affecting productivity, and we'll certainly keep an eye on that. But as it relates to taxation, right? And if we believe that the corporate taxes, and as he's pointed out in his call it economic plan, that he wanted to lower corporate taxes from 21% to 15. Will he get there? I don't know, but certainly the direction of staying the same is a win compared to 28% that I know Kamala and her policies that she was, or excuse me, her economic focus was pointed towards. We would take the lower, and then the personal taxes potentially coming down as well. We'll see. The fact that the earnings per share growth and the fact that the companies have to pay taxes, and that could be a certain impact to the positive versus the negative. What is your take on the valuation and earnings per share outlook based on the data we have today? We're talking about 11% earnings growth between now and next November. We had a handful of companies guide lower. We had a handful of companies guide higher, more so lower. But we're pretty strong as it relates to the 11%. How does the tax scenarios that we anticipate alter that in any way, and how will it affect valuations?
Yeah, so it's not as dramatic as the 2017 tax cut, where instead of going up 13% in 2018, S&P profits were up 26%. So it was they doubled actually in terms of what profitability was. This would be more modest but positive, particularly against a backdrop where you're selling at 22 times forward earnings. I was listening to Lee Cooperman, famous hedge fund manager on CNBC this morning, and he was a little bit more bearish in the longer run, suggesting that this pop is going to go for a period of time, but he'd be a seller of the S&P at 6,400 based on earnings, facing earning, I should say, valuations facing some headwinds in 2025. In fact, he even said he expected the market to be down in 2025. There's some precedent for that in any presidential cycle. The first year is the poorest performer of all four. The third and the fourth years are generally the best two performers. So typically, though, the Fed's also tightening during that window of a first or second year of a president's tenure. So it'll be interesting to see if the Fed can continue lowering rates while all this other stuff is going on at the same time. So if you do get a tax cut, that would be a buffer against any other potential outlying factors that might affect the economic or market outlook, and that might make earnings valuations or PEs look more reasonable. But right now you are at 22 times forward earnings, and long rates are going up instead of down, as we both noted. So that changes the discount rate on how you go about this. So look, I mean, we'll see. It may also, though, as we said earlier, open the door to a lot of M&A activity, some IPO activity, and so you might just see more market action all the way around that would offset something coming in less than 11% profit growth next year. Oops, I think I lost.
Sorry about that. Just to put it in perspective with some of our viewers that maybe a little bit early stage in understanding data. So the price to earnings ratio, price divided by earnings per share, historically in the last give or take 5 years, we've ranged at about 19.8 times earnings. So in other words, the earnings divided by the price, the earnings per share divided by the price, the more inflated, the more, as my wife would say, that is not on sale. And then the lower the PE ratio means, oh, look, we're getting things for free, which I argue, but we're certainly paying less. And right now we're looking at a PE of 21.8 times future earnings, which is an elevated number. So you're paying a little bit more than history has said. But what I'm arguing, or at least questioning, is, hey, if we get a reduction in corporate taxes, that's going to increase earnings. It's also going to pass through to discretionary income and spending. And is that a concern? And then you pointed out one of the analysts is looking at about a 10% move in the S&P before we really get to a point where we have some concern and we're really lofty. And I sat here back in the 90s and I was a student to the market, even though I was a broker, and I watched PE ratios expand during the dot-com bubble to levels that we are nowhere near.
No, not even close. No. I mean, I think the NASDAQ had a nearly infinite PE in 1999, and you had companies that were raising $100 million with no product, no revenues, no profits, and that was even with respect to AI, which people think is in a bubble. I happen not to think that's the case, not right now. If there's going to be a bubble, it'll take place over the next 3 to 5 years. We've done the infrastructure part. We've talked about this, I think, in prior conversations. We're in the implementation phase, or the applied AI phase of this process. And so we haven't seen the full proliferation of this yet, which may well be profound for a lot of different industries, medical, healthcare, pharmaceutical development, legal, financial services, productivity enhancing stuff.
Yep.
That would be a boon also to the environment. But, again, I think what's interesting here is that you may have a lot of cross currents in the next year or two that we're going to have to wade through. And assuming rates don't go dramatically higher, it might be an easier call to make with respect to how equity markets perform. If rates do shoot up, as you and I both know from history, it's very difficult to fight that from an equity market perspective when you're selling at nearly 22 times earnings. Then you have to worry
Let's talk about that,
direction,
Ron. That's the elephant in the room, if you ask me. I mean, there's a lot of elephants right now.
A lot of
surrounded.
Yeah.
But you have to think about the fact that, hey, the Fed lowered rates 50 basis points earlier this month, or excuse me, not long ago, right? And yet the 10-year went from 3.5, 3.6 right back up to 4.2, 4.3 recently.
It's almost 4.5 right now.
I know you said the 5-year, the 10-year as well. I'm having trouble. My TV over here that tells me that I don't want to turn
10 years approaching 4.5.
Wow. So listen, one would say, well, if they're lowering interest rates, why is the 10-year? Let me explain. The Fed fund rate is the short-term rate. It's the daily rate that banks lend or get, the float, if you will, to have the cash on hand. And it's the first rate in short duration. And then it goes from there to other 90-day and 2-year and 5-year. So the fact that they're lowering the short-term rates doesn't necessarily apply to long-term rates. And what I also will say before I hand it off to you, Ron, to articulate, is we've had an inverse yield curve. We've had a higher short-term rate and a lower long-term rate, which is a sign of a recession for literally 2 years now, maybe longer. And that's not healthy. And also it's not normal. So now that we're seeing the longer-term rate go up and the shorter-term rate go down, we're like, what's going on here? And maybe that's just the normalization of hopefully a post-COVID getting through this. But talk to me, Ron. I mean, what's your thought?
I mean, so I've had a lot of, so since I think it was July of 22 when I took my recession forecast off the table, because the inverted yield curve where short rates were higher than long rates was not having an impact on households and corporations in the way that we've seen in prior periods, typically because mortgage rates were locked in at extremely low levels. So people didn't refinance and didn't sell. So household balance sheets remained relatively intact because they weren't as interest sensitive when the Fed was raising rates as they had been in prior cycles. And that was true for major corporations as well, that when rates were at zero, they were locking in long-term debt at very, very low rates, and there was no need to refinance as rates were shooting higher. So I think in a weird sense that rendered that inverted yield curve, which is typically a recession indicator. In fact, since 1968, every time the curve has inverted, you've had a recession somewhere between 6 and 15 months later. That didn't happen this time around. Now the curve is disinverting and normalizing, and that would tell you that growth is holding on. Inflation might be ticking up a bit, or maybe anticipated to tick up a bit, depending on the policy combinations we're going to see going forward. And the Fed may or may not lower rates from here. So you'll have quite frankly, the yield curve's kind of flat. If the Fed were to lower rates tomorrow by a quarter point, you're at like 475. So the 10-year is still below Fed funds. The belly of the curve has normalized, but not the extremes. And
flat. We have a flat yield curve.
Flat yield curve. Yeah. So I'm not quite sure what that message is at the moment, and I think it's going to take some time to play out. I have been watching inflation break-evens, and they have, since the Fed first cut rates, they've gone up rather decidedly by more than half a point for the 5-year break-even, the 10-year break-even, which is bond market expectations of where future inflation will be. Those have turned decidedly upward after having fallen below the Fed's target of 2%. So I'm keeping an eye on all those things to determine whether there's some sort of unexpected reacceleration in inflation and what that does to Fed policy against, again, all these disparate policy suggestions we've had from the incoming Trump administration. So I think this is, Jeff, I think there's gonna be like a lot of three-dimensional chess from an economic standpoint in the next several months that we're going to have to figure out how each one of these things individually affects the economy and how they affect the economy in concert if they should all happen at once.
You're so knowledgeable. I appreciate that. So just to bring it to the level, as interest rates go up, borrowing costs go up, and therefore the valuation or what you pay for a business goes, it's more costly. If you're paying more, then your PE ratios or the price you pay for a public company is offsetted on a negative fashion versus when rates go down, we get an expanded, call it valuation PE ratio. So PE ratios are extending during lower interest rate environments and vice versa. So we're watching this very closely because we're concerned with interest rates and valuations as we get a little lofty. And I remind the audience that having worked through expansions that are triggered by technological advancement, I've been through this before. And I'm going to make one comment before I come back to you, Ron. There's something called FOMO, fear of missing out. And there's something called capitulation. Capitulation goes both ways. When people are selling and in a panic, there's a capitulation where investors say, I'm done. I don't care if it's the best company in the world. I'm out. That's capitulation on the downside. There's also a capitulation on the upside where investors have FOMO, fear of missing out. And they're going to say, I don't care that the company's trading at a multiple that's outrageous. I am missing out and I'm getting in. That will have to occur, in my opinion, before we're out of this secular bull market, if not long-term bull market. And we haven't had it yet. Whether it comes near term or long term is anybody's guess. But I'm going to share with you one other point before I lean on Ron. The impact that this blockchain and this AI is going to have on everything we do is going to be explosive. It's going to be violent in a very positive fashion, and then certainly unintended, potentially negative consequences, like everything similar to the internet did, and social media, and God knows what else that we'll find out in generations to come. But the fact is we are going to have the benefit of what this new technology is going to allow us to do on a daily basis, whether it be from business or just from a personal approach to how we live. Autonomous vehicles, logistics, execution of transactions, healthcare. Instead of spending years to figure out the solution for our loved ones, we're going to get days to use a blockchain algorithm to decide what's the proper approach and drug, call it mixture of cocktail, to suppress the diseases that we have. And that's something that's exciting, but also scary because we don't know. And we're afraid of change in ways that we can't figure out mentally, but it'll be ultimately just similar to the way we're talking today. Who'd have thought back in 1995 when I got into the industry, I'd be looking at you across the country like you were next door to me on a TV and Zoom, like we do without hesitation. But I'm going to pause and I'm going to ask one question.
Yeah.
And I'm getting to my time where attention span is lost.
Yeah.
What sectors? We know that the market has upside. We're concerned about valuation. We're concerned about interest rates. We're concerned about the unknown of the new regime. What sectors would you be focused on, if at all, or what sectors would you be concerned about, if at all, Ron?
Yeah, I would be concerned about anything that's currently being incentivized by the U.S. government, whether it's electronic vehicles, whether it's electric vehicles, I should say, whether it's, anything having to do with maybe even infrastructure. If they roll back the Chips and Science Act, I think it probably makes sense to be favorably disposed towards financials, because if we'll have to watch the interest rate structure, but when you look across deregulatory regimes, really almost any industry, whether it's, industrial, whether it's financial, whether it's pharmaceutical, if indeed there's going to be broad deregulation, that immediately, in energy, additionally, those areas may benefit. Now, energy is kind of a double-edged sword, because if oil prices were to go down dramatically, it's going to be hard for large energy companies to lever those falling prices into higher earnings. So you'd probably see a lot of consolidation in that space. Whatever's left of the media business will likely consolidate, and whether it's a takeover or a take under, I think is an open question given the dynamics of the business. But then I think, small caps, because they have a domestic focus and aren't subject to tariffs. One of the reasons they're probably up 4% today is that very reason, is that if indeed there are across the board tariffs on imported goods coming to the United States, small cap companies that manufacture domestically would not be adversely affected. They would actually benefit. And so you had a pretty big pop in that sector today. And so it's one problem. And they have by and large underperformed for quite a number of years. So they may be ready for their moment in the sun.
Good stuff. I have to push back on one question in that, our view, and I mentioned this early on, is where we're at today is important, but where the puck is going, as Gretzky used to say.
Yeah.
So this, having lived through the internet and all that came with it and saying, okay, who benefited first, second, third, fourth? I'm having the same approach. We're in the process of putting it together a portfolio that's inflationary, as well as one that is involving the valuation of the dollar and energy. Let me just say this. That the AI is going to explode and blockchain is going to be the catalyst. And then ultimately the way that is going to be implemented, whether it's the chips initially, which is where we're at today, or the power that we're going to need to utilize that AI.
Yeah.
And we talk about energy. We talk about a broad sector of energy. And I'm watching Microsoft take on nuclear plants. I'm watching 3 Mile Island be reopened. We can't be blind to this. The demand for energy and AI is going to be explosive. And how do we navigate that, Ron?
Well, I mean, again, it's antithetical though this might be to, a Trump administration to provide incentives for any particular industry. You're going to need it, because if indeed you want, and look, there's some of it will be necessary, some of it won't be. There's a lot of activity taking place in modular nuclear facilities that are safer, cheaper, better designed. Will take some time to come online, but we are looking at a future in which nuclear power, and you mentioned 3 Mile Island, or you could look at Chernobyl after that, or you could look at Fukushima in Japan, and all those tragic events that occurred in each one of those reactor groups. That hopefully is a thing of the past, and so modular nuclear seems like the thing of the future, but it's still several years off. But those power companies that are actively engaged in that space are going to get a premium ultimately, because the percentage increase in the demand for power based on AI, based on really a lot of things that we're doing here, and quite frankly, restructuring our transportation industries as well. All of that's going to be increasingly reliant on electric power, and in the interim, also natural gas as that transitional fuel. So there are a lot of plays in that regard that make a lot of sense. Energy writ large, when you're talking about oil, if we're going to drill, baby, drill, and oil's going to 60, that's not going to have a positive impact on the exploration and production companies, even downstream where you're talking about distributors. If gas falls below $2 a gallon, which would be a stretch, but even if it fell to $2 a gallon, again, the refiners might do well because they're refining a lot. But again, the prices are down. So I think you have to be somewhat discerning when you make those plays. And when you look in the utility sector this year, it's been up, big double digits, reflecting at first, the demand for increased power, and then two, the notion that rates were going to come down dramatically. That's probably less of an influence on utilities today. But again, you have to pick your spots with respect to individual companies as who's going to benefit the most from that energy transition, and not just look at them, in the aggregate. I think selectivity is going to be really important going forward, particularly when you talk about things like energy.
I think that's a great spot to pause and end this part of the discussion. And what I took from that is it is extremely sophisticated and knowing where to go in just one sector.
Yeah.
So with change or with the changing of the guards, and in this case, remember we talked about the fact that the probability of outcome was a Republican president and a divided House and Senate, call it Congress. It looks like we're going to have a clear red, call it House, Senate, and presidency, which means change is coming, which always creates opportunity ultimately, but it creates volatility because there's uncertainty. And this is a prime example of energy. I mean, we know energy is going to be the highest demanded factor in everything we do, including AI and everything we do day to day. And yet we're sitting here thinking about who's going to be negatively impacted by the policies because of the lower cost of oil coming from the ground, as they call it, liquid gold. And yet we know that the demand is going to be greater, and you have to balance between the two. There's going to be certain benefactors, and there are going to be certain companies that if they don't shift or adjust, they're going to be negatively impacted because the cost per barrel of oil drops below a certain number, which today was coming into today was $70 roughly a barrel. If that number drops below a certain threshold, apologize for not knowing what it is for this moment, it creates certain companies to be non-profitable.
Yeah.
And as well part of the country. So that is a very good point, Ron. And I'll leave that with I'm going to actually pause on what I'm going to leave it with. I'm going to ask you for your last comments, Ron, and then I'm going to summarize the conversation.
Yes, I think, putting all politics aside, I think, there are a number of uncertainties. We're getting a favorable response today. I think we're going to really have to sit back, sharpen our pencils, and do some real work and go really policy by policy individually, and then look at the impact of those policies in the aggregate to determine what the economic impact is going to be. That's going to take, I think, a lot of work in the next several months. And I think that this is going to be an intellectual exercise from an economic and market perspective that might be more challenging in some ways, even though it's currently deemed positive, than we've seen in the past. Because trying to make this all add up, and trying to pick the winners and the losers is going to take some real brain power here. And so I think there are no easy answers as to how everything works out when put together. So I think you really have to look at each narrow slice individually to see how they might perform under, as you say, a changing, set of policy proposals that are most assuredly going to come our way very quickly in 2025.
Uncertainty. That's what I hear.
Yeah,
and the market's reaction today is obviously very welcomed as an investor that's invested. And then it's also, hey, we're getting ahead of ourselves. Things will settle down somewhere in the middle, and then we'll see some of the more, call it fundamental details that'll align. And I've said this before, our job is to understand each one of our clients' businesses and family dynamics, and what their budgets and what their needs for liquidity are, and what their risk assessment and ultimate goals are, and build portfolios that are designed around those factors, because everyone's unique in their own way, and including companies. So we have to be balanced. We have to put ourselves in the position to be able to overcome any unforeseen factors like a market correction, and be able to ride through it without selling and having the capitulated I give up mentality. We will not allow it. And then also be able to take advantage of it. When people are running that way, we're coming this way. When people are running this way, we're going that way. And that's the way we have been doing it for decades. Maybe not as early on, but now, and these last, call it the second half of my, I believe, successful career, because of all of you, we've learned those the little details that are going to separate you from the pack. That's going to give you that extra edge with less risk. That's the way we're going to approach it. I thank you, Ron, for always being willing to jump on and help us out. And regardless of where we're coming from in our views, we always come together and utilize your knowledge, your experience, and your input that none of us has the benefit of. And I appreciate you, and I appreciate our audience.
Thank you.
It's a great day. Let's make it even better. And I wish everybody the best. Be well, and I'll see you all soon.